Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in. Let's take a look, see what people are sharing. If you want to follow me at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these sectors topics looking for potential investment opportunities. If that interests you, if you're interested in learning how I'm looking at companies, what I think is good for this commodity bull market, definitely sign up. Try it out. We've got a coupon code special. You can use that coupon code special for a monthly membership, 50% off. And then you can sign up later to a yearly membership if you like. And when we run these discounts, you can sign up for the yearly membership and get a bigger discount. So Mike Zaccardi says, energy with the highest total shareholder yield. Why does that matter? Because you're a shareholder when you buy stock. So this is the last 12 months. This is dividends and buybacks minus issuance divided by market cap. Okay, let's break this down. Dividends is what they pay you back as a shareholder in terms of cash to you. Buybacks is when they take cash generally from cash flow and buy back shares, shrinking the share count, which means that on a per share basis, you get increased production per share, increased free cash flow per share, which is what you want. And then they shrink the shares and their earnings get distributed over a smaller amount of shares, driving their earnings per share higher. A lot of companies that don't make cash flow have to issue shares. That's your uranium sector. They have to raise money, or gold and silver, junior companies that aren't making any money. They dilute, dilute, dilute. So that's the buybacks minus issuance divided by market cap. So your market cap is the size of the company. Your size of the company is your share price times the number of shares that are outstanding. And that's your market cap. So when we look at this, energy is giving the largest yield by sector. Now, there are certain companies within energy that blow 6.6% out of the water, because that is the average for energy. So you might be getting 13%, 10% of share buybacks in some of the companies, not all, very few. But that type of return is absolutely ridiculous, to be buying back 5 to 10% of your share count. Here's oil. I think oil is a huge opportunity. I've released a midweek update talking about my opinions. I show a lot of different ratio charts. But here's Casper. He says, if oil can break out from this mini 4-year triangle, which happens at roughly $78 to $80 a barrel from 2020 to 2024, that's the consolidation that we've got. Oil could be one of the best trades for the year to come, as discussed with Finding Finance. If we can get a break here. Now, this isn't, I do technical analysis, but I am a hybrid investor. What does that mean? A hybrid investor means that I look at a lot more data than just the technicals. I look at, for instance, we have low commercial inventory levels right now. So that would suggest that oil needs to go higher, not lower. But oil isn't priced all the time just off of inventory levels. You also have to look ahead and say, well, how much spare capacity do we have? What's the demand look like out in the future? So far, and what I've gathered, is that demand is very good and the future is questionable. We don't know what that future outlook necessarily looks like, and if the market is maybe anticipating a slowdown or recession. But when I look at the charts and the way that I view them with the ratios and all of this stuff, I am a bull. And I think that we are going to go higher in oil. Now, what happens if I am wrong and this dips lower? Well, then I'm wrong in the short term. It dips lower. And what can I do in that situation? Well, you could sell at a loss. You could put a tight stop loss on it, but I don't use stop losses. I don't. What I'm going to do is I'm going to ride through it. I'll ride through it if we get a dip, and I'll see you on the other side. I think that there's going to be more tightness in the future than there is going to be overproduction. And that deals with the fundamentals, the Dukes, drilled uncompleted wells, inventory dropping lower, low commercial inventory. And then I am in the camp that shale is peaking. And I'm also in the camp that Saudi Arabia is probably also peaking. So if you take the two big boys, America and Saudi, which is the two largest oil producers in the world, if they are peaking and demand continues to grow, where's oil going to come from at $70 a barrel or 75 or 78 or whatever it is? It's not going to be coming, and it's not going to be flowing at this price. Also, if you look at ratios, oil is cheap to gold, it's cheap to Dow Jones, it's cheap to silver, it's cheap to a whole bunch of different things that you measured against. And guess what else? It's about to break out on a lot of them. Maybe even all of them soon, depending on how oil performs over these next few months. So I think this would be one on a radar to be watching. I don't need to tell you anything more than this on uranium. Sources UEC's presentation. So this is the anticipated cumulative production gap for uranium. In 2025, it's 58 million pounds. By 2034, it's 356 million pounds. And by 2040, it is greater than 1 billion pounds for the mid case. By 2040, annual demand is about 360 million pounds as the high case, and the annual production is 132 million pounds is the mid case. And that's highlighting that gap that we've got out there. Now, there's a couple of ways to look at this. You can look at it, and this is the uranium. If you've got your uranium glasses on, you say, holy moly, we need a lot more uranium. Uranium price is going to move. That's the uranium glasses. Now, I take my uranium glasses off, and I put my natural gas glasses on. And I say, holy crap, uranium's going to be short. I bet that they can't produce that amount of uranium. So I bet that they're going to build a whole bunch of natural gas power plants. So I'm willing to bet that the gap in uranium could be bullish for natural gas because natural gas is the swing producer for electricity. That's my natural gas glasses. And then I put on my oil glasses and I say 2040, we better be ramping uranium as fast as possible because I think oil production is going to actually go down by 2040. I don't think we're going to go up from where we are today into 2040. I think that we are going to be substantially lower. And what scares me here is oil is in everything. It's a huge determining factor of inflation. So the question then becomes, well, how profitable are uranium companies going to be if oil moves? That is the question. I don't know. But we're going to have to do this either way. The question then becomes, who's going to make the money in 2030s and 2040? Where's the money going to flow from in the world to companies? Who gets the largest, we'll call it return on equity? A lot of it's driven by the commodity price. So even if uranium goes up and up and up and up and up, it may or may not make as much money as another sector, depending on what you're looking at. So for instance, if oil goes to $500 a barrel and uranium goes to $500 a pound, who makes all the money? I would say that I'd rather be in oil companies than uranium mining companies under that scenario because they have infrastructure in place. They're already producing and some of them already have a bunch of reserves. So I think that they have an easier path to make more money if that scenario comes into play than a company that doesn't have any infrastructure in place, hasn't hasn't any equipment, no employees, none of that stuff. So not only is inflation going to hit them pretty bad, you're also going to have a bunch of issues and risks trying to build the mine if it's not already developed and producing. And you can look at Paladin just restarted. Paladin has been pretty rough, and they're just doing a restart. I can't imagine building a mine from scratch. It's going to take a lot. Here's Yennefer. She says, I'll say this. I'm 27 with a salary job, yet I struggle to pay rent, car note, insurance, and all my other expenses. Now imagine someone expecting me to pay theirs as well, and dates, buy gifts, and if I don't, then I get blasted for not being a man. I wouldn't want to date as a man either. And that's 80% of single men are no longer interested in dating. They're not even trying. Why is this the case? Men only. Well, um, I'll just say this: when you're young in your early 20s, late 20s, what you don't want to do is you don't want to have a car note, which means you borrowed money to buy a car. You want to buy a POS. Buy a POS, run it into the ground, learn how to fix your car, learn how to do oil changes, be handy, learn how to fix things yourself. Get roommates. Get roommates so you don't have to pay the entire rent. Cut those expenses down as much as possible. When you get a crappy car, a POS car, your insurance for car, do liability only on a really old car that you pay a couple grand for. That's going to help you out tremendously if you do that. So what I did growing up, I had roommates. I cut the rent way down, and I also cut my expenses because if you split something four ways, like your internet bill and your electricity and all this other stuff, it is cheaper. Then I drove an old car, super cheap. I put liability insurance on it only. And then I watched my other expenses. I would eat at home and eat healthy food for a cheap price because I was making it. That's what you do when you're in your 20s. You don't live a lavish lifestyle in your 20s because you're just starting out. It's just the way it is. And if you want kids and you want to start dating, then save that money for later. That's what I did. But people don't have that type of foresight, I guess. Here's Phil Fisher's investing philosophy. Let's go over a couple of these ones that are circled here. Have the moral courage to act against the crowd when your judgment tells you that you are right, and that is not following the herd. Buy stocks of companies that are likely to generate dramatic long-term growth of both revenues and profits. That's exactly what I focus on. Buy the particular gusto when stock market conditions are not favorable or other investors do not properly perceive these companies' true worth. And that's generally when market sentiment is garbage. Retain the investment in such a company as long as its advantage over competitors remains intact, and never sell for short-term reasons. Never sell for short-term reasons. Hey, look, a recession is going to be coming up. Never sell for short-term reasons. Never sell for short-term reasons. You want me to say it again? That is what kills people. They try to time the short term, they get left off the bus, and the bus takes off. Or the rocket ship, whatever it is. Because if your primary investment goal is the substantial and long-term appreciation of your capital, as it must be if you restrict your portfolio to the most outstanding companies, then you should reduce the emphasis most investors place on the importance of dividends. Recognize that mistakes are inevitable. The important thing is that the investor recognizes a mistake quickly, accurately diagnoses its cause, and does not repeat it. And I would disagree with that. I would disagree with that because if you're a long-term holder and you've got companies, you don't need to win on everything. You need to win on just a few. Now, The short-term outlook for a company can move up and down. And now you are trying to make a decision if the company is still good or bad. And it highly depends on the judgment of the investor. It also depends on if the investor is reading the market conditions correctly and if they are even aware of changing market conditions. Some of these companies do very well under certain market conditions. They do poorly under others, and then that market condition comes back into cycle and it does very well again. So the movement of the market condition, the business cycle, whatever it is, seasonality even. When you take a long-term approach, a lot of people will say, "Oh, look, the return on equity is lower or something's changed." It's like, well, is it in or out of cycle? Why don't you hold through it and just wait? A good Fisher-Wright investor is willing to incur a short-term loss that results from a poor investment and lets the gain from a good investment grow over the years and decades. Recognize that the investment universe contains very few truly outstanding companies and that opportunities to buy them occur very infrequently. Hence, concentrate your attention and your funds in the most desirable opportunities. And I agree with that. The problem is most investors that are new have no idea what to look for. Do you look at the balance sheet? Is that going to tell you what's good and bad? And I'm going to tell you it doesn't. The balance sheet doesn't necessarily tell you if a company is good or bad. It just tells you what it's done. It doesn't mean it will continue to do that well, and it doesn't mean that it's going to go into cycle or out of cycle. Most of the time, balance sheets look the best at the end of the cycles. For individuals, in possible contrast to institutions and certain types of funds, any holding of over 20 different stocks is a sign of financial incompetence. 10 or 12 is usually a better number. And I think that number should be higher if you're in higher risk commodity type stuff because you can get nationalized. There's problems with mines. You can get a flood. You can get something to occur. If it's a company that converts commodities to usable products, then yes, you can hold a lot fewer companies. Never forget that one of the most basic rules of life also applies to investing. Success is highly dependent upon a combination of hard work, intelligence, and honesty. And I would also say that your viewpoint, whatever you're looking at, is the correct viewpoint. The way that you see the world, your ability to translate what the world is closely relates to how your paradigm of how you're looking at that world. There are people who look at the world completely different than what I do. I may look and see a situation. They see the same, situation there, and they come up with a completely different reason for why that situation exists. And I just look at them like, oh my God, like how did they come to that conclusion? If you look at the market that way and you come to incorrect conclusions, you won't make money. No matter how hard you work, no matter how intelligent you are, or honesty, because there's intelligent people that view the world very weird. There are very dumb people that view it correctly. It only depends. North American LNG export capacities from existing and future projects. Look what's coming here, guys. This is the forecast. We are right at the beginning. Big move in LNG coming online. This is going to be the fun part of natural gas going higher. Do more here. Every investment should be succinct. 3 to 5 bullet points, massive tailwinds, obviously cheap, obvious upside if it plays out. A range of outcomes is too wide for Excel to matter. You instantly get it. If you have to think about it, then it isn't obvious. This is the way. And it's one of my investing goals for 2025 is to not use Excel modeling, full stop. As my friend says, you can't explain the thesis on the back of a napkin or an FT article. You shouldn't own it. Every investment should pass this test. A lot of people, they try to do projections, net present value calculations, all of this stuff. And it's, in all honesty, guys, It's the ability to see the future more clearly than the ability that everyone else can see it. Or you take advantage of situations where people panic in the short term and you don't, and you buy it. And then when that panic subsides, everything moves up because they regain their logical side of their brain, we'll call it. Now we've got Kobayashi letter. This is absolutely insane. Heading into 2025, there are now 100 times more assets in leveraged long funds than leveraged short funds. Over the last 8 weeks, this ratio has doubled, exceeding the record high set in November 2021. Is the bull trade too crowded? Yes. It's too crowded in AI, crypto, and the S&P 500 and NASDAQ. You don't want to be where the crowd is. The crowd is just a bunch. Okay, so the crowd is a herd of people that just run to price performance. That's all they do. Now, it's enticing for most people to chase price. I get it. I completely get it. And it's very hard to adopt a different strategy because everyone thinks kind of in a linear function. They think they look backwards, it's going up, then they say, oh, it's going to keep going in some linear function and it's going to keep going into the future. It's very hard to adopt a strategy where you're buying something that's gone down for 10 years. You buy it when it's down and starting to come up, and people can't see that future. They think linearly where, oh, this has been doing crappy, it's going to continue to do crappy. That's where you make all the money. That is where you make all the money. And you have to be patient for it to play out. It's not about making money fast. It's about making the most amount of money with the least amount of risk over a set time frame. And you need a time frame that's long, not short. People will say, well, it doesn't make money fast enough. I want to return in 6 months. I'm just going to say you're going to go broke. What you're going to do, you're going to go broke. You're going to go broke because this is what happens. You're going to chase price performance. You may win some. You may do very well in a very short period of time. And then all of a sudden, you're going to give it back. And then you're going to wonder, how come I didn't make money? You're buying overvalued, chasing price performance potentially, and then you're writing the things down. And that's almost what all new investors do. MicroEdge Resite says multifamily delinquencies are nearing the great financial crisis high as new apartment inventory continues to outpace demand for high-priced rents. And that is percent of total number of multifamily loans. And this is the delinquency of 60 plus days in foreclosure. That is looking a little bit rough there for multifamily. Christine says revenge of the old economy equals growth to value rotation. She's talking about energy and some of these other ones. So it says, can someone please explain in American English why the stock market is crashing today? It's going to be a rotation. And Christine's right. It's going to be revenge of the old economy equals growth for value rotation. And I think that's what we're talking about, capital rotation, the big capital rotation that some other people talk about. It could be underway, just starting. Correlation economics, the big picture. When USD goes back to its fair value, hard assets will soar. You are correct. This is another tailwind behind hard assets. The dollar is super strong. And this is the US dollar's divergence from fair value all the way back to 1995. So it's undervalued in 95, overvalued in 2002-3. And keep that in mind. That was the 2002-3 was the peak in the dollar, and we had a huge commodity bull run from 01-02 all the way down to 2008 and then even 11. If you look at the US dollar divergence from fair value, this chart here directly correlates with the price of gold, directly correlates with the price of most commodities. So we're coming from the most overvalued dollar here, and it could still go up. I'm not saying I know the direction of that dollar immediately, but when this reverses, oh my God, we're going to see hard assets absolutely rip. And you want to buy when this is overvalued. You got to wait. You got to be patient. When this goes up, commodities will consolidate and correct. When this goes down, like 2020, you can see this big move lower. That's when they ripped. When oil ripped. When emerging markets ripped. It's coming back. Don't worry. JC says 2025 is going to be the year of $100+ silver. Over 400 million ounces of deficits in the last 2 years and no supply elasticity. This Gazprom news could be a big catalyst to ramp stockpiling for Europe's accelerated solar deployments. Again, the dollar is going to be the one that has to fall here for silver to really take off, in my opinion. The silver priced in dollars means that the denominator has to fall. Energy policy failures have consequences. So I talk about oil production and GDP, which is more or less energy production. This here is your correlation in a country of what I'm talking about. So this is energy and exports drag German GDP into a 5% shortfall. Look at the correlation here. Energy rolls over, global demand rolls over, domestic demand rolls over, supply chain rolls over. It all rolls over. Energy's the driver, guys. Generally, that's the driver. If you screw your energy up, whether it's power delivery or it's the cost, people will leave. They'll say it's cheaper over here, let's go over there. They screwed it up. NVIDIA just extended 223% above its 3-year moving average, a new record. Like previous occasions, a large correction seems likely. Note that MSTR is already down 46%, but overall, NASDAQ is still fine. It's a mixed bag that needs very careful monitoring in the weeks ahead. See my pin post. This is the target zone for a bull market top. We hit that in July of 2024 or so, and we've rolled on over. Support resistance zone is where we're at. We could see a potential big decline for NVIDIA. Investment wisdom. If you can step back and take a longer time horizon, that is the big secret. That's your time horizon. The short-term guys get slaughtered, guys. What you want to do is step back and take a longer time horizon. Charlie Munger says, if you invest the way people gamble at casinos, you're not going to do very well. It's the long-term investment that works best. These guys are literally coming out and telling you long time horizons. And this is exactly what I'm doing. I'm doing exactly what they are telling me. And guess what? It works. Now, the US dollar just closed the month at the highest levels in more than 2 years. What's to come next? I do think that we could still go higher in the dollar in the short term. And that will impact some of my investments. But guess what? I am spread out amongst a variety of undervalued commodities and areas, emerging markets. And emerging markets could get hit. They're going to get hit with a stronger dollar for a period of time. I'm going to continue to buy it. It is so underpriced. It is so undervalued that I don't need to play a 6-month or quarterly performance gain. That's not I don't need to do that. What I want to do is I want to position in things that are cheap, sit and wait. This will eventually play out, in my opinion. Cycle Bottom says, as 2024 comes to a close, it's been a shocking year for value investing, particularly commodity microcaps. The setup now is looking rather interesting through 2027. Plenty of bottoming is underway, which I agree with, which can easily continue for another up to 9 months, which is totally true. He says a wider market drop will result in a delayed bottoming of commodities and value, but the current levels are offering attractive returns over 3 years. We continue to have sufficient dry powder for all outcomes. 40% of this would be deployed on a 35% drop in our fresh, repeatable, asymmetric opportunities in such sectors as lithium, gold, potash, industrial metals, etc. Of course, in retrospect, microcaps which have been completely destroyed. 2025 will continue to be a year of deployment. 26, 27 will likely be the boom in commodities. And I would agree with that. I really would. That's a wrap for 2024. Here's how commodities performed over the year. Nat gas being very strong. That was one of my higher conviction commodities. And what I used was the ratio. Natural gas was the cheapest commodity of any commodity in 2024. And guess what happened? It just so happened that it was one of the larger returners. Gold, silver looking good. Tin, zinc, aluminum. I do have some in platinum. Palladium, I've been watching. I don't really own anything in it. Lithium is down. I've been watching lithium for potential entry points here because it's down. Copper, crude, they were basically flat. Nickel, flat. And that's where I'm going to end it, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website. Use that special coupon code. And that's all I've got. So we'll catch you next time. This is Finding Value.